For those that aren't familiar, this is Tech Talks. We've been doing it now for about a year or so. Prior to that, it was called Crypto University. And we like to look at it as kind of the intersection between traditional finance and emerging fintech or emerging technologies. And that's certainly going to be the case today. We're going to be talking about wealth tech, which I'm looking forward to hearing a definition of what that is. And we've got our guest, Josh Herman, who many of you know, and Paul Fiore, who many of you know as well. Josh is the CEO of Digital One. I had the benefit of working with him prior to that role at SRM. So he was on my team and super excited to see Josh's success. Was also an NCUA Principal Examiner and former VP of Strategy at Frankenmuth Credit Union. And then Paul, probably a lot of you already know Paul. He's a strategic advisor to CU Digital One and going to be transitioning into a more permanent executive role in the not too near future. He's had a lot of successful technology companies, including being the founder of Digital Insight, also a payments company called DoubleBeam, CU Wallet, a mobile application provider, and was also the CFO for Affinity Credit Union. And you guys can probably do a better job of introducing yourselves than me, but want to thank you guys for coming on this talk. And we're going to be talking about wealth tech today. So if you guys want to kick it off with anything you want to just kind of give a background on that I might have already touched on, and then I've got some stats I'd like to share with the group, and then I've got some questions, obviously. But again, this is going to be fairly informal. We're just going to have a conversation about all things wealth tech. We got some others on the phone that have experience and also working in that space. So want this to be an open conversation. Does that sound fair?
Yeah, I think I would just add two things real quick. It's always a pleasure to talk with you, Larry, and be on these tech talks. We did change our name yesterday to CU WealthNext, and we'll talk about kind of that pivot as we go through here. Do pay attention to our social media pages. We have an exciting announcement coming out tomorrow, so make sure you pay attention to that. And then I know we do have, Larry, like you mentioned, several experts on here as well. So if anyone has anything to add as we go through this, please feel free. We want to make this educational and conversational.
Yeah, so CU WealthTech. I mean, that's going to take me a little while to have that ingrained in my mind. So forgive me if I keep saying CU Digital One, but great name. Super excited hearing more about it. I guess to kick it off, I want to share some statistics. I did a little research prior to this call, and I know I've mentioned this before on another call, and this number still boggles my mind, but there is $50 trillion, and that's trillion with a T, that is going to transfer of wealth from the boomer generation. Apologies for any boomers out there. I'm pretty close. I think I'm a Gen X, but to the Gen X and the millennials and younger. And that's a huge amount of money. Now, some of that's real estate, some of that's investment, some of that's bonds, and probably it's fair to say a fair amount of that's probably tied to 5% of that group probably holds a vast majority of it. But nevertheless, a lot of those assets are going to transfer to the next generation. And we think it's real important because we know, at least from our experience, that a lot of investment money, even banking relationships, have gone out to various fintech providers that are offering wealth tech solutions. And I looked at what are Gen Xers and what are millennials doing with investing? And millennials apparently are big on impact investing, which that kind of fits that genre. ESG investing, they tend to be, I was surprised by this, have higher cash holdings and more conservative investors. And then Gen Xers, which I think I'm one of those. Oh, someone's on. Let me put someone on mute. 1 second. There we go. Yeah, so Gen Xers, apparently they're confident in their money skills, which, I fall in that category, and often focused on self-directed investing. So, I thought that was neat. And, looking and thinking about some of the providers out there, right? Some of the ones that everyone's familiar with are Robinhood, Acorns, Webull, Betterment. But some of the other ones are from actually the big providers, right? And like Vanguard, robo advisors, they've got $206 billion of assets under management. Charles Schwab has about $65 billion of investments under management. And again, these are in the kind of self-directed app solutions, but those are a lot. But if you look at the numbers, like Charles Schwab, which they've got an intelligent portfolio, it's called, they've got 65 billion. By comparison, Robinhood has 89 billion, but the big difference there is what the average investment is. So the average investment holdings of a Robinhood holder is about just a little shy of $9,000. The average holder of a Schwab investor is about $250,000. So very different segments, right? And as credit unions and community banks, which a number of them are on this call, know that we are competing to some degree to retain deposits and offer wealth type solutions, which a lot of people already do through Raymond James or LPL. But how do you reach out to the 98% of your members or customers that don't fall into that wealth management category, where they're looking for very personalized investment advice, and maybe they're younger and don't want to talk to an advisor, maybe they don't have enough assets to warrant that. So I just wanted to provide that as context going into this conversation. And then maybe Paul and Josh, you can talk a little bit about what is, I think a lot of us kind of have a feeling of what wealth tech is, but what falls in that category? What makes something wealth tech?
Yeah, so that was, and I know, like I said, I know we have a lot of experts on here, but to me, that was a newer term. Everything seems to be fintech these days, and you see everyone works at a fintech. Everyone has a fintech. Everyone's partnering with a fintech. Fintechs are ruining the industry. Fintechs are helping the industry, and the word fintech is everywhere. Then here comes the term wealth tech. So usually before I go through and do these different discussions and conversations, I like to at least say what it means to me to kind of level the playing field. So underneath fintech is just technology company that operates in the financial services space, generally speaking. And then underneath that, you're going to have other categories. A fintech can be payments, it can be wealth, it can be lending, it can be a wide array of any other type of categories. But then there's underneath that, there's going to be insurance companies or insurance tech type firms, and that would qualify as insurtech. And so firms focusing on wealth management and ancillary products around wealth management would fall under the wealth tech space. So this would include wealth management software, like I said, trading platforms, investment software, a lot of different things that fall into that. At CU WealthNext, we're really focused on the self-directed investment platform side of things, and we'll get into the opportunity for the credit union market, but we believe it's a hugely underserved market right now that hopefully changes in the near future. Yeah, I think from a wealth tech terminology standpoint, that's how I define it. Paul, I don't know if you have anything to add to the definition there.
No, I think you did a great job. I'll save it for the next section.
I do have a question. So you said self-directing, and when I think about wealth management and wealth tech, I think of like three categories, and maybe there's more, and I could be totally wrong on this, but I think of self-directing, I think of robo advising, which could kind of is a little self-directing, but I think a little different, and then your traditional advisory investing. Are those the right ways to look at it? Are there other categories that kind of fall within that wealth management, wealth tech?
Yeah, so there's a few that are emerging and have emerged. So robo advisor was kind of the terminology of 2023. I'm starting to see the top firms rebrand that as automated investing. They're getting out of the robo advising and moving towards automate. It's like going from crypto to digital assets, just a terminology change, but it's really the same thing. But those are using algorithms, data analysis to provide optimized portfolios and things like that. Then there's digital wealth platforms. These can deal with goal setting, budgeting, portfolio tracking. If you work with a financial advisor, that individual will be using some sort of digital wealth platform, whether it's Morgan Stanley, Merrill Lynch, LPL, whoever you work with. Then there's AI and machine learning, and we're seeing a lot more use cases, a lot more discussion around this. And then this next one is kind of where I want to toss it to Paul here, because we're starting to see a lot of use cases in wealth tech around blockchain and cryptocurrencies. And I know, Larry, you have a lot of experience in the space. I know, Paul, you do as well. So Paul, maybe if you want to talk about blockchain cryptocurrencies for wealth tech.
Sure. Maybe I'll start though with a new kind of category starting, which is in between the managed services and self-directed, what I'm calling a hybrid. So today you pick up the phone, you call the 800 number for Fidelity, and it's press 1 for managed accounts, press 2 for self-directed, and they kind of figure out what bucket you go into. But I noticed just personally using sites like Robinhood and eToro, part of my research and due diligence, I'm noticing that if I do a large trade or put money in or take money out over a certain threshold, I will get a voicemail from eToro or Robinhood saying hello, offering for me to talk to one of their advisors. And I see in the financial institution world, not just to delineate between the guy in the branch that just inherited $1 million versus the young member just getting started with 500. How can you have a complementary service to take care of both of them? But to the question about blockchain cryptocurrency, there are members today and consumers in general that are self-custodying their digital assets. And a big challenge in the industry is when somebody dies, how does their heirs know that that asset's there, how to recover the account, and what to do with it? So we came across an interesting company that's solving that problem with an Ethereum layer-based Web3 system that the consumer who has the crypto not name some beneficiaries, right? Could be a charity, could be a relative, and including how that mix is going to be split. And then upon their death, which they figure out because of a way they interact with the person by sense of email, and then if it's not responded to, they accelerate, and eventually it triggers after so many weeks of non-reply, the liquidation. And this company essentially then on a smart contract, it triggers to take out the gas fee and split it up the way people want. That's just one example, but in general, you can see that there's going to be dozens of unique cases that crop up in the next 5-10 years, all with the same goal. How do financial institutions serve their members and customers and interact properly with all these great creative fintechs?
Yep. Paul, that's fascinating you mentioned that about the crypto and the I don't think the right word for it, but basically when someone passes away and they've got to pass that on to the next generation, the complexities of that is really can be a big issue. And that gets into the self-custody versus full custody. But I saw today, I think it was Block has an offering called BitKey, but they do a 2 of 3 signature. So you can have someone that can ultimately help you recover if you lose those keys, or if someone passes away, institution could hold one, someone else could hold one, and then you could hold one. So it is neat to see the solutions are coming around in that fashion. But yeah, I think that's just one of a lot of self-directed kind of alternative investments that are starting to pop up in this space, right? Can you guys maybe give some examples of some other sorts of investment categories that maybe aren't the ones that we're traditionally used to, stocks and bonds, but are there other ones out there that might fall into a self-directed investing category?
I'll give some more exotic ones, and then Paul, you can give the conservative one. So there's companies out there called Masterworks, Songvest, where you can invest in fractional artwork. You can actually go out, and if you want to buy a portion of, say, Shrek's soundtrack, you can actually own a portion of that and collect royalties. If you want to own a fraction of baseball cards or sneaker collections, it's obviously self-directed. I don't know if a robo-advisor is going to go out there and actually recommend you get into those different classes, but it's more exotic, more fun type things to do. Again, those are through like Soundvest, Masterworks, and things like that. Another category, and we're not looking strongly at those right now, but it's another category to consider from a self-directed standpoint. Then there's another category on the real estate side of things. And Paul, maybe if you want to talk about fractional real estate ownership.
Yeah, sure. The only category in the last 25 years that's outperformed the S&P 500 is real estate. And if you're a young person getting started in real estate, it's all the basic advice you'd get from a financial advisor that would take care of that Schwab $250,000 client that Larry mentioned, which is get started early, be convicted of your things, don't become a day trader, don't try to get in and out of projects, don't trade build wealth for the long term by making good decisions and doing what you could afford. So we came across a company that it's called Concrete, spelled CONCREIT, like a real estate investment trust. And Billy Larry, they were on one of your podcasts as well. We discussed it in the past. And it's essentially a in-market. It's in the App Store. You could download it today. You have 50,000 consumers using the software where you could put as little as $10 into a fund that's generating. It's a cash flow fund that generates income. It pays, I think today, 6.5%. They put it into your checking account weekly. But they just also launched a couple of months ago a single family home purchasing product where you could buy for as little as $100 a fraction of a home. They launched a home in Kentucky, a home in Tennessee. The company essentially, buys the house cash, no leverage, and then leases it out. Each individual home with all the investors that are part of that are registered with the SEC as a special purpose vehicle for real estate. And we're looking at investment in that company and helping introduce them to financial institutions as a resale partner.
So maybe you guys, because you guys do a lot of work with credit unions, and again, there's credit unions and community banks on the call, but maybe you can provide us with kind of a status of wealth tech, both inside the credit union industry, maybe outside the credit union industry. Like, so who are the competitors? What's the space look like? What are the solutions that are coming for outside and then kind of for inside? If you could maybe talk a little bit about that.
Yeah, maybe Paul, if you don't mind just giving a high overview of how you see the wealth tech space.
Yeah, so in general, for every asset class, so let's take the three we discussed today. There's digital assets, the member or consumer wants to buy Ethereum. There's stocks, they want to buy Tesla stock, and there's fractional real estate, they want to put money into a piece of a home. Each one has multiple layers of things that are required to have that solution work. Part one is the regulatory framework, right? You need a custodian for digital assets, a FINRA regulated broker dealer for stocks, and you need a SEC registered service for the real estate. You also need the clearing engine and platform from that, right? So most small banks aren't going to get in and start clearing. You're going to need not only your own broker dealer and an RIA, but you're going to need a trade execution, clearing and settlement component, everything that solution entails, including e-statements and tax reporting, right? So credit unions that are new to saying, hey, we're decades behind E-Trade and all the other self-directed platforms. We're not a bank, so we can't afford, or we don't have the capital structure to buy Payne Weber or some of the old brokers, dealers. So we're going to provide our own platform. It's another world of software clearing, back office implementation. And then there's the integration layer, right? There's the tying it into your core systems and making it work, not just for the settlement of the funds and the KYC and the onboarding of the consumer, but also to make sure for customer support, when the consumer walks into the teller, they'll have access to the value of the dollar amount of the investment you made, or to answer basic level of questions. And then there's the front end, right? If it's the consumer's already experienced eToro and Robinhood and E-Trade and Fidelity, they're probably not going to want a software that looks like it was done in the DOS era. So you're going to want a kind of full featured front end. So what Josh and I are working on, and with the team that we're expanding and the credit union owner partners that we work with, is can we coordinate the various companies that are already in market with products and the regulatory framework, the front end integrations, the back end integrations to the cores, and the clearing and settlement engine behind the system with the lowest, best wholesale price. So as an industry, we don't have to identify 10 different companies. Because last point on this, having been in the fintech world for a long time, like there are always startups that start in the space. So why E-Trade is not going to license back their platform to a small community bank or a credit union, much like Greenlight's probably not going to do that. Although they'll do affiliate partnerships with banks and credit unions, they already have your customer and they want more of them and they want their dollars, and they don't want to give you the tools to offer the same services they have, which means you need startup entrepreneurial companies, but they're undercapitalized. They're only serving a small set of the market. It's difficult to compete and hire the best compliance people, executives, engineers. So then you have 10 companies all competing with the same handful of leading financial institution, progressive individuals, as opposed to consolidating and rolling up those vendors in a way where you could bring one comprehensive solution to market. So that's the problem we're aiming to solve.
So I think yes, answered a question I had, but was really around some of the challenges for credit unions in this space, and I think you just explained that. It's funny you mentioned the name Payne Weber. I haven't heard that name for a while, but to that point, how important is a name, and are there differences between older and younger generations, right? I think there's probably a lot of folks on the call that might only be, and I'd be curious if maybe you guys can do this by reacting with a thumbs up or whatever, but like how many people on this call use a kind of a self-directed app of some sort that's not traditionally with an E-Trade, a Schwab, a Fidelity, a Vanguard, one of the big brokerage houses. So if you use like a Robinhood or a Betterment, just react with a thumbs up or a heart or something. I'd just be curious how many folks are actually using those. I certainly fall in that category. Okay. So to that point, how important is that name, and is there a difference? Is there a generational differences? So, right. So you guys are launching a solution, or you have a solution. Is the fact that you guys are new, is that a hurdle? Is that an opportunity? Does it matter to a younger member versus an older member? Maybe you can address that a little.
Josh, maybe can I take the first stab at this?
For sure. Yep.
So, I've been a student in the industry for so long of what companies emerge and kind of take over and get critical mass in the banking sector, right? Sometimes it's really simple. The laws pass, it's ERISA, enables the invention of the IRA, and then thousands of banks offer IRA accounts inside their services. And you could always go historically, product by product, as something gets introduced. It could be a competitor offers something, and then 1,000 banks follow suit. One of them really recently was Zelle launching and getting to critical mass in the industry, and how long it took the banking industry to have our answer to a simple problem, right? You want to pay the tutor or the piano teacher $50, you write a check or do you use your phone? Well, PayPal came out with a solution in 99. Zelle came out in 2017. So why does it take 18 and a half years essentially to have a basic competition? And in the meantime, you get Cash App and Venmo. So I think it was a name Venmo. If you talk to bankers, they will tell you we're getting crushed by Cash App and Venmo. So we built our own homegrown P2P system, low volume, low transaction, but at least we had on par with what was out there. They switched to the Zelle brand and got 100x returns. One executive in Los Angeles was sharing they were doing 4,000 transactions a month. The month later, they used Zelle, they got 400,000 transactions on the Zelle platform. So the first part of your question is the name. I believe the name is important because the same feature functionality, I could pay $50 to the tutor from the ABC Bank's mobile app or from Zelle. Why does volume go up 1,000x? It's because the brand, the consumer trusts it. They could tell the piano teacher. I believe on the product side too, no one's going to leave Acorns or Betterment or E-Trade or eToro for an individual bank's branded app. Yes, it's more convenient because the money's at your bank or credit union, you could pull it in and out. But if it were part of a brand that seemed like a national presence, I think it would give the consumer more faith and confidence that this is going to be around for a long time. And maybe Josh, you could cover the last piece on millennials versus the baby boomers.
No, I mean, I totally agree that the name matters, and I have a list of names that we'll run through in a second, and it just becomes part of your vernacular that you associate that name and that brand with that product. Very, very similar to Zelle. But then how do you get those? I mean, so a new product in the credit union space or in the financial services, how do you get those new customers and new members over to your product? There has to be major differentiators and they have to be obvious. So it has to be a good name, but it also has to be different and better, which is obviously part of the combination that we're working on. But one of the points here, I have a list of names I'm just going to run through of successful wealth tech companies in the space. And once you mention name, Larry, I start looking at these going, I don't even know what some of these names mean, but you just associate them with the space. So SoFi, eToro, Stash, Coinbase, Cash App. Chase actually has a pretty good embedded solution, Robinhood, E-Trade, Fidelity, Schwab. And then these final three I want to park on for a second. So Betterment does a really good job of looking like a credit union. They are a credit union. They're about 50 billion in assets under management. They've been around less than 10 years, about 800,000 users. They'd be one of the largest credit unions in the country if they were a credit union, and they've only been around less than a decade. Wealthfront is about 40 billion, in assets under management. They've been, again, around less than a decade, about 700,000 users. Again, one of the largest credit unions in the country, if they were one. And then Acorns is about 20 billion. Same type of statistics. So we're talking about 110 billion just in these bottom three names that aren't as wide known as the other ones that I listed off, that aren't credit union owned solutions. And so credit unions sit back and wonder, where did all of our deposits go? It went to these three names at the bottom, plus more. I think to address one of your questions there, Larry, about the name and all of those things, I think it's important to note that not one credit union solution would be considered a top wealth tech solution. And to Paul's point, a white label solution here isn't going to do it. There's over 5,000 credit unions and over 2 trillion in total assets in the space. And not one credit union solution beats out the other names that I listed, despite them trying to act like a credit union. And quite frankly, they're all doing it very, very well.
I would add Kasaka is an interesting brand that for checking accounts crossed over to banks and credit unions, but showed the value of a national brand.
Well, it's crazy. A lot of those investing solutions that you rattled off, I was thinking about what, traditional finance does, right? Deposit relationships, debiting credit cards, investments, insurance, CDs, mortgages, loans. Like a lot of those solutions, they have deposit relationships. Like you can get a deposit, often a high yield one, which competes with CDs. You can get debit cards through them. You can get margin account loans, right? You can get personal loans. So a lot of those really are starting to look and feel like traditional financial institutions. And maybe the reason why the CFTC is starting to look at them and go, okay, if you're playing in this space and you look like a bank, you look like a credit union, well, we're going to regulate you like one. I want to pause for a second. I didn't know if I saw there was a hand raised. Catalina looked like she had her hand raised, but I couldn't tell if that was reacting to my earlier question or if she had a question. So I'll pause. And Catalina, if you have a question, just jump in there.
I was reacting to your question. I couldn't find the other. A little simple, but yeah.
Nope,
thank you, Larry.
That works. So So let's say a credit union wanted to offer a solution, a self-directed investing solution, whatever you want to call it. What is the benefit of that? Is it that it gets more eyeballs on an app? Is it that it brings in new members at a lower cost to acquire? Is it an entry point for wealth management later? And then, so not only what is the reason for offering it, but then how do you compete with some of those brand names out there that maybe are offering commission-free trading?
Yeah, so I'll start, Paul, and you can go ahead and pick up. So one of the things when we're talking to credit unions and community banks to be in the same bucket is they're looking for revenue, with CFPB and all the other agencies out there looking to erase fee income, and the margins are obviously compressed too with cost of funds and things like that, and also liquidity. When these assets leave your balance sheet, so when your shares of your credit union leave your balance sheet and go to Betterment or go to Stash or Robinhood, they're leaving, and you're not getting any revenue off of that. You can't lend against it. You can't, unless you have some sort of other agreement for equity lending, but that's not the point here. But you lose a lot of potential for revenue when they leave. Then you're also losing the odds of them coming back, because as we talked about, these places are trying to look and operate like a traditional financial institution. They're going to offer you debit cards and high rates and all of those things. The advantage for a credit union is, if I go out and buy Apple right now, it's still leaving the credit union's balance sheet. But if they have an agreement with a credit union-owned solution, they can get some non-interest income revenue, some recurring revenue, some rev share coming back from their member participating in this solution. Also, the way that our solutions are looking to be structured, and I'm actually running into this. I as all of us do, I test out various apps, and I sent money out, played around a little bit, and now it's kind of stuck in their ecosystem right now, and it's sitting in their account, and I can't get it back into my bank or credit union account right now. Whereas with the solutions that we're looking at implementing, as soon as you sell, it goes right back to your credit union checking account, so you can use it immediately. So if you're at Target or wherever, and you need as a member need liquidity, you can immediately liquidate your investments and and spend that money as it goes back into your accounts. There's several advantages. One of the things that our couple of crypto partners that are up and running noticed was, and I noticed this as a tester and user, was I used to go into the app maybe once or twice a week or once or twice every couple of weeks, see if the paycheck hit, and then make sure your credit card balances are being paid off and make sure there's no fraud. And that was the whole reason for ever logging into my credit union account and credit union app. Once you start opening up a crypto platform, these institutions are seeing a whole lot more engagement from their membership. And so it's going from one login once a week to 10 times a day for those who are active and checking their balance routinely, which means credit unions can now position their offerings and products around the crypto icon and things like that. And so if you own an insurance company or if you have loan rates you want to get out there, you can now position those around that within your app as well. So it's a little bit of free advertising, but those are the main ones that I see. Paul, I don't know if you see any other opportunities for credit unions there.
Yeah, it's stopping the deposit exodus, maintaining the member relationship and the customer relationship, generating revenue. And I think the key here is that financial institutions die 1,000 paper cuts, right? You don't have that extinction event that Blockbuster had when Netflix came. It happens overnight. You have thousands of financial institutions and millions of consumers who don't close their account when some better product comes along, but they move their kids' spending card to Greenlight. They move their, they move 100 little small things a little at a time as they interact with all these fintechs. And back in the day, if you offered a second mortgage and the bank down the street offered a home equity line of credit, and they put a big bulletin board up about that new product, wouldn't be long before you stopped offering second mortgages, started offering HELOCs. But in fintech world, 63 million Americans opened the brokerage account. And as an industry, we didn't even bat an eye or figure out decades later what to do about it and how to counteract that. So the answer is, I think, collaboration, jointly working together to understand these giant threats that are just slowly killing the industry that we need to react to.
Yeah, I agree a lot with the increased usage of the app, especially with crypto, because that trades 24/7. Certainly with stocks or any sort of investment, you're going to get more engagement with that app. You're going to make them stickier. One thing I hadn't thought about, and I don't know that there's enough examples to point to this yet, but let's say just with crypto and the ability to trade 24/7, and maybe that changes, right, with ETFs and people start to leverage ETFs instead. But with traditional crypto trading 24/7, I wonder if that also increases the support needed for after-hour support from a credit union, right? Because not everyone's got 24/7, 365. But all of a sudden, and maybe it's not a crypto question, but I'm in my crypto app or my app, and I'm checking my crypto balances, and I go, oh, wait a minute, I thought I had, this was my debit card transaction, or I thought I made a deposit. Why am I not seeing this deposit? So it also might change or shift some of the call center activity. But again, that's another point.
Well, I mean, so just to address that, and that's one of the questions that credit unions ask too, is not even extended hours, but how do my front lines be prepared to answer some of these questions? Number one, the answer is they shouldn't. There's certain regulations and licensing that goes into place, but the partners that we're working with are offering tier 1 support, which is obviously experts. And in the case of Concrete, the co-founder will actually get on the phone with an investor and walk the individual through certain things. And I know I've had after hours questions, and they always have someone with a green light next to them ready to answer all your questions. So that is a real issue that credit unions are asking about. And thankfully the partners we're working with are already ahead of that.
So you mentioned partners. If a credit union is looking for a partner with a wealth tech firm, what insights would you give them? I
guess I would toss that to you, Larry. You consult with credit unions and community banks on a daily basis in this space, obviously a trusted resource. So what should credit unions be looking for?
So obviously the partner has appropriate licenses in place for one.
Yeah.
To Paul, to your earlier point, depending on the investment type being offered, there are a lot of different licenses, whether it's with the SEC, whether it's with a custodial agent, and some of them could be state and federal. But what I would say is that these wealth tech solutions are fairly new to the marketplace, and they may have a partner behind it that has existed for a while, but a lot of them are new. And the level of due diligence and the questions you should be asking are far different than the level of due diligence questions you ask when you re-sign a core agreement or you do a branding agreement, right? I mean, these companies, you've got maybe liquidity questions, or you've got like who are their custodial agent questions, or who are the third parties they're using, or how well funded are they? Are they going to be around in 6 months, or are they going to shut down the program? Those are the kind of like really detailed questions you need to be asking that go beyond your normal third-party vendor relationship. And of course, SRM, we could help you with that, but that's really, this isn't meant to be a commercial. But yeah, it is a very different, and I think it's also more to like, who are you really comfortable with as a partner, right? Do you believe in the management team? Have they been around for a while? If you're a credit union, do they understand the credit union industry? If you're a community bank, do you understand community banks and how they're different than the top 10 financial institutions? So there are very different set of questions you would ask to find that kind of partnership. But Paul, I don't know if you had anything to add on that, because you've been in this business for a long time.
Yeah, I'd echo everything you said. There are several vendors in the space. I know just coming back from a big conference like GAC, there's probably 15 booths of vendors. We, full disclosure, invested in one company called Investify. They were formerly known as CryptoFi. So sharp people there. But our goal is to how do we narrow that list so that there aren't 100 choices, because it's hard to get traction and scale when there's too many vendor selection choices to make.
Yeah, it's a good point. Question from a regulatory standpoint. Do you see, so one of the things the CFTC has been talking about is open banking, right? And that's supposed to, I think, kick off towards the end of this year or next year. And there'll be a rollout, kind of tiered rollout, as I understand it, based on the size of institution. But with open banking becoming a thing, and to some degree, we have open banking today, right? So there are options out there to get into your checking or savings account and to share data or whatever. But like, how might that impact a solution that self-directed investing solution, maybe a solution that you guys are offering? How does it make it harder? Does it make it easier? Does it make it a more competitive environment, less competitive environment? Do we see fintechs taking off, even getting stronger? Or do we see, traditional finance companies actually regaining some of their their advantages?
I'll start off, and my answer is going to be kind of short. I think any opportunity for increased competition, especially in this space with 5,000 credit unions, I think there's 5,000 banks, so you have 10,000 FIs all competing, and some of them haven't made any changes in 20, 25 years. I think anything that can increase competition for the better end user, whether it's a customer or member, I think is ultimately better. Now, is it better for the FIs if they adopt and adapt? But I think ultimately anything that is better for the end user is better for the industry.
And to the regulator part of the question, Josh and I were able to participate in an event hosted by the federal regulator for the credit union industry. And of course, they don't recommend or support any particular solution, but in general, the overall health of financial institutions is critically important, and that requires you to work with innovative companies to have solutions that are competitive in the market to offset the income that's being lost from bounce check fees and other sources that are dying down. So it's a general acceptance that this is important and we need to collaborate, and they're trying not to be roadblocks as long as they're putting the due diligence on the financial institution to pick the right partners and the right solutions.
Mm-hmm.
One thing I think these sort of solutions would really help solve for, and it's something the industry is always looking to come up with solutions, is how do you serve underrepresented people who really haven't had the benefit of experiencing some of the wealth growth that others have. And you've got wealth management companies that are addressing that 1 or 2% of the population that have massive amounts of assets. But as we really want to shift to focusing on people who haven't had the same access to financial services, and they need to be able to build their generational and multi-generational wealth, like these are the kind of solutions that can offer them real opportunities, right? Because they're never going to get an account with an investment advisor at Vanguard, but they might be able to get an account with, an offering through their credit union. And, they may not have a ton to invest, but $10 a month, if you add it up and you do it over a lifetime with compounding and growth in those underlying investments, can end up being a lot of money. And so I think there's that aspect of it that sometimes we don't talk enough about that's probably pretty important.
Especially starting with the education side. And that's one of the things that credit unions tout as being something that they're really good at is financial health, financial education, financial literacy. And so a solution that's owned by credit unions in this space really needs to be focused and reward members for going through the proper education and learning. Because to your point, Larry, CUNA put out a survey last year. I think it came back to only top 3% of credit union members actually utilize an in-branch RIA or an in-branch advisor, leaving 97%. So either 97% don't want to meet with one, or 97% or a portion of 97% don't have access to one, don't know they have access to one, don't have the tools to start it on their own. And so a solution in the credit union industry needs to really be built the way the credit union industry was built, and that's on financial literacy, financial health, rewarding for making the right decisions, and making sure they have the right tools to do it themselves. And then one of the questions we get is, well, doesn't this compete with my in-branch RA right now? And the answer is absolutely not. This is a handoff if that's the direction the member wants to go. But we think shoving your member to meet with an advisor when they don't want to, and the advisor might not be incentivized to give the same advice to everybody based on the fees and different things. We think give your members the choice if they want to go self-directed, if they want to go robo/automated for a certain amount of time. Then once they get enough assets, or once they feel educated enough, then they can go and sit with your in-branch RIA. So we don't view it as competitive. We view it as very complementary.
Yeah, that's a great point about education, because, if I always thought of these products as maybe a feeder for wealth management, but if you start someone early enough and you educate them and they get comfortable with these asset classes and understand the benefits of diversification and compounding, by the time they get to having enough assets that a wealth manager might be appropriate, they might feel like they know enough. And for some people that will be great, and for some people maybe they look to have a wealth management relationship. But regardless, you're locking down that relationship with the credit union or community bank, as opposed to letting that go off to a third party that is increasingly offering other sorts of financial products.
Yep, absolutely.
So I know we've got, let's say, about 12 minutes left. I want to give some time for questions from the audience, but I also want to give Josh, you and Paul, 5 or 7 minutes of just anything that we haven't discussed, things that we should have asked from a question standpoint, points that you want to get across, maybe a little bit about your roadmap of where you guys are going. I want to give you an opportunity to kind of wrap it up, and then we'll ask the audience for questions, and then we can riff on this a little bit more if they don't have questions. But
yeah, I'll just, and Paul, then I'll turn it over to you. The opportunity here for credit unions is huge. We named off maybe 20 brands that credit unions aren't associated with in any way possible. And if you want to be your members' primary financial institution, you have to have the tools that your members are looking for. And whether you do a survey or not, your members are telling you exactly what they want with their spending patterns. And their credit unions are seeing these funds flow out. And it's going to be not very long until you're not going to see the funds flowing out. You're just not going to see them flowing in to begin with, because as Betterment and these other ones start acting like an FI, they're allowing direct deposits to go straight into those institutions. So you're not just going to be an intermediary to flow these funds out to collect a paycheck. You're going to be disintermediated. And so the opportunity here for credit unions to build an all-in-one embedded investment solution that educates members and does it the right way is huge. And I'll also add this last note, and then I'll turn it over to you, Paul. When we look at Chase and we look at Bank of America and we look at Wells Fargo, they measure themselves by total assets under management and deposits and loans, which are assets and liability. But the way that we look at this is, say Chase is 3 trillion. Maybe 30% of that is actually on the deposit side or on the loan side. where credit unions measure themselves as total assets, and then they measure themselves by loans to assets. And so there's a perspective difference in the way that both sides of the industry are comparing themselves. And some of the testing that we've done in a few conversations with credit unions is approximately 10% of credit unions' assets could be equated to assets under management. So if you're $1 billion institution, you could have another 100 million in AUM through your LPO or whatever advisor that's already there. And then you can start comparing yourself equally to Chase and those other institutions. But it's just a perspective and perception difference on how the different institutions view themselves. Because typically credit unions don't even know what their total AUM is. And so I'd encourage those on this call to go and see what that is. I think you'd be surprised at how big of a number that is and the opportunity you have for your members.
Josh, before we turn it over to Paul for comments, when we look at outflows, and we did this when we were looking at it mostly for outflows to the crypto exchanges, it was surprisingly consistent with about 1.7, 1.8 million per month for $1 billion in assets held. In deposits. And if we included self-directed investing solutions, I bet you it was probably like $3 or $5 million per month for $1 billion in assets. So, your $1 billion institution, you're losing probably $50 million a year in deposit outflows to those sorts of solutions. And boy, to retain any of that and to keep that relationship is pretty important. But
you can
Paul,
either, I'll just say, you can either raise rates, which every institution likes to do. And so you can compete with your neighbor down the road and go 5, 6, 7% and increase your cost of funds immediately. Or you can implement a solution that meets where they're actually going. But I'll stop interrupting. Paul, go ahead.
Yeah, what do we have as an industry? We have the customer, the channels, and the relationship with that customer. If you're a fintech, but you're struggling with this customer acquisition cost, churn, lack of engagement. So what we're not good as an industry is incubating, ideating. We don't have software engineering teams building the next acorns, right? So the game plan has to be, what can we do? We could concentrate our efforts, collaborate, provide capital, provide guidance, provide access to the integration partners that we work with on our other systems to be able to align with the fintech in a way that gets that product into the hands of our customers as quickly as possible. So I think that's the last tip I'd give, and take a Q&A.
That's great. And let's go ahead and open it up for questions. And you can also put questions in the chat. I did see something here. Oh yeah, Rob said 350 billion a year in outflows. Yeah, that's a big number. Generational preferences are huge depending on deciding which set of wealth management solution to have for credit union members, RAs versus online brokerage. Yep, I would imagine that as well.
And Lear, we can kind of riff off of that comment. Great comment, Catalina. That was one of the questions that we had initially was, do we want to create a credit union professional stock trading platform, or do we want to go the route of helping credit union members create wealth for themselves along with education? And I think based on how short I gave those responses, we can kind of guess which one we landed on. I think we're more of in the betterment type solution as opposed to a stash or a public type trading solution. But Catalina, great point. Addressing what your members actually need, not just from a holistic view, but also from what demographics make up your membership. Yes. I think is hugely important.
Yes, it is, and thank you. Good to hear your voice and see you. So one of the things I was gonna say with this whole wealth management too is it's not just the generational preferences, right? Because it's also how they save and how they view the wealth building throughout their lifetime. The FIs I came from, we used to have what we call the financial, it was almost like the financial roadmap of an individual. That was, like starting with the little checking account on and on until they had their credit and then their auto loan, their mortgage, and all these things, or they became a business. Now it's like, the Gen Zs or any of them, they're going, oh, well, I'm going to do my little summer job, and $100 every time I get paid goes to Robinhood. That's how they think. It's a very big difference. The way in which they see it, where they want to go. They don't want to talk to people. Not yet. I don't have $100. And so I think, as a credit union, as a financial institution, who is your member base? What do they want? How do we attract them and keep them? And then lastly, I would just say too that, self-directed IRAs, we're a big fine for like even the corporate, I would call it population, whereby you have your 401k, your money was tied with traditional equities, and suddenly, the self-directed IRAs started coming out, and you were able to take a little money and put it into alternative assets. That being, first was crypto, of course, can be gold, can be other things that the traditional financial institutions couldn't support. That's another trend that I just want to throw it out there because it keeps growing, right? But anyway, it's a great subject. Thank you very much.
Great points, Catalina, for sure.
Any other questions or comments? I've got one last question, Josh, and maybe in some of your research that you've done on some of these apps. Is there any gamification kind of built into these where like you could have a leaderboard, someone who's really great at investments, and you could kind of follow that leader? Is there anything like that?
There is, and I think Robinhood got too good at it with some of the issues that they ran into. But I think done the right way with the right motives, there's definitely big use cases for that. That's kind of when we're talking about education and rewarding financially healthy decisions with gamification, and whether it's on-screen animations or actual monetary type rewards. I think there is definitely space for that, and that's definitely something that we're looking to have as we move forward. Paul, if you have anything to add there.
We liked one of the things the app Concrete put in their app that you could get on the App Store is kind of these guardrails. So when you make a decision like, hey, I want to liquidate, just reminders, the best investors, the quotes from Warren Buffett, the buy and hold philosophy is think for the long term. You're never going to force a consumer to take action, but you can give them good advice, right?
Great point. A great way to end today's segment. Josh and Paul, this was a really insightful conversation. I truly appreciate your time. I appreciate people's comments and thoughts. This was really interesting. Super excited, Josh, to hear about the name change, and wish you guys the best luck in the future. And I think you're in a good space. So thank you to everybody who participated. And we'll have the video. Video will be made available, the recording, probably in about 2 days or so. It'll be available Monday morning, more than likely. But again, thank you, everyone, and have a great afternoon. Take care.
Thanks, Larry. Thanks, everybody. Bye.
Thank you.